The last move was in November of 2023 when the RBA hiked them by 25 basis points to 4.35%, and that's where they've stayed for the past year. Now, the reason is inflation, which the Reserve Bank says is still too high. The purpose of raising interest rates is to cool down the economy, and it appears to have been successful with inflation falling. But the RBA still wants to see underlying inflation fall further before it begins to cut rates.
OK, Nadia, we'll come back to you when that decision is officially announced in, a minute and a half's time. In the meantime, Let's go to David Taylor, who's down at the RBA itself. So, David, what factors will the bank be looking at?
Well, Ros, employment and the change in the employment conditions, GDP and inflation, of course, it needs to be down within that 2 to 3% target band. But, Ros, here's the dilemma that the Reserve Bank has got. The economy itself is slowing considerably and is basically crawling along the ground. Holding it up, of course, is spending on public services and government spending, both state and federal, including infrastructure and things like that. So if you look at the economy as a whole, you'd think, well, if it's just the government holding things up, well, surely the Reserve Bank can come in and provide the support to mortgage borrowers, but it's just not that simple. And what I mean by that is that the Reserve Bank needs that trimmed mean figure to be between 2 and 3%, that smoothed out figure to be between 2 and 3%. And whilst the government is supporting the economy, you've got other costs like rent and out-of-pocket healthcare costs and insurance costs and things like that. So the economy is basically holding up okay. There are items in the CPI basket that are just too elevated at the moment in order for the Reserve Bank to be comfortable. And then to add a third element, of course, productivity. Now, productivity is just too low at the moment, which means the supply side of the economy can't generate enough activity to overwhelm the demand in the economy. And some of that demand, as I mentioned, has come from the government. So the Reserve Bank, as I mentioned, is in a very tricky situation. The economy is slow, but inflation is still too high. It'll be interesting to see what the Reserve Bank governor will say as to how she views the chances of a Reserve Bank rate cut in the next few months. OK,
David, thank you. Nadia, you have news for us?
Yes, so just in, the Reserve Bank, as expected, has left interest rates on hold at 4.35%, saying underlying inflation remains too high, and that is for the 9th consecutive meeting of the RBA board. And this was their last meeting of the year, so we won't see any movement now on interest rates until they next get together on February 18th. But most economists are at this stage, based on the data we have, predicting rates won't go down until May. Well, let's bring in now for more on this decision that's just in economist Angela Jackson. Hi, Angela. This was the expected outcome, rates being left on hold. What factors do you think were most influential in the board's decision today?
Yeah, look, thanks, Nadia. And it was very much within expectations. I think it would have been a real shock before Christmas, a welcome one for households out there, obviously, especially those of us paying mortgages, but a real shock if they had have cut today. Look, I think going to David's point, the issues the Reserve Bank's really facing at the moment is how confident can it be that inflation is going to indeed return to target in the medium term. It wants to make sure that it has done enough to slow the economy down, to bring inflation back within target. When it is confident enough, it will start to ease monetary policy and those rates will come down. Now, I've only managed to just glance at the statement from the Reserve Bank in about the 30 seconds I had from when it was released to when I came on air. But it looks like that confidence is gaining. So there is some important changes in what the Reserve Bank's saying after this meeting, which should give some people confidence that they are getting ready to move on cutting rates. That will make households feel a little bit better going into Christmas, that there is some hope of that relief, hopefully early in the new year. But we will have to wait and see. Before they next meet in February, we'll get another read on inflation, which will be critical in terms of whether or not that confirms that downward trend. And of course, we'll continue to see what's happening in the labour market. Now, the labour market's remained very, very strong, and that's one of the reasons the Reserve Bank is hesitant to move. If we see some increasing weakness in the labour market, then I think that February rate cut becomes even more likely.
Done very well to speed read that statement in the past 30 seconds. We will hear more on that statement from my colleague shortly. But, you know, the question everyone wants to know, I suppose, when do you expect to see interest rates will start to come down?
Look, I think it will certainly be in the next half of next year. The question is whether or not the Reserve Bank moves too soon or too late. So they are really, and we've talked about this, it's a tightrope. They're trying to bring inflation down without causing a recession. Now, we've seen with the latest figures in terms of how the economy is growing that the only thing keeping the economy in the positive at the moment is the government, is fiscal policy. That means the private sector is very, very weak and is really calling out and urgently calling out for that rate cut. The Reserve Bank will move when it feels confident that it can do so without unleashing those inflationary pressures. Now, the hope is that that will be in February. I think there is all indications that really we're getting enough indications now that the economy has slowed enough for the Reserve Bank to start easing monetary policy. But we are going to have to wait and see. It is going to really depend on what the data says between now and then about whether or not the Reserve Bank feels confident enough to move. They've been relatively conservative, it would be fair to say, as a central bank goes, and central banks tend to be relatively conservative. And I guess the risk and the concern that some economists have is that they wait too long, and as a result, unemployment goes higher than it needs to and the economy slows more than it needs to.
That is a key concern. What sort of economic data will the RBA be wanting to see in the next few months before it begins to cut rates? Just talk us through the significance of some of it. We hear a lot about GDP, unemployment data, wages. You were talking before about labour market data. What are the really key figures that would sway the RBA's decision next year?
So I think if they can see unemployment starting to go up, which is a pretty negative and I guess Grinch-like metric to be aiming for, so wanting to see more people out of work. Unemployment stayed at around 4% for most of this year, and the Reserve Bank had been forecasting that to head up towards 4.5%. It hasn't happened. If they start seeing more weakness in those labour market figures, that'll be an indication to them that maybe they have indeed gone far enough. And then they'll get another read on quarterly inflation. We get these monthly inflation figures, but they're not the whole picture. It still really comes down to those quarterly figures, and they'll get another read of that at the end of January. If that comes in again with that trim mean and particularly that services inflation starting to come off, that will give them a bit more confidence that indeed inflation is coming back towards target and that perhaps they can think about cutting. They've certainly seen enough weakness, I would say, in terms of the GDP figures. We saw with the figures coming out last week exactly how weak the Australian economy is. It's literally crawling along the ground at the moment. So they've definitely seen that figure, but when that translates through to unemployment and to those inflation figures, that's when I think they'll have more confidence to move. But look, if it doesn't happen in February, it'll definitely happen by May, and we'll start to see that easing. But then there are still these remaining issues within the Australian economy that need resolving. The housing market remains incredibly tight, and that's causing higher rents than perhaps necessary. So there are more structural factors at play as well, of course, that the Reserve Bank doesn't actually have much control over, well, none actually, through interest rates. So there's a broader conversation to be had as well about how do we generate this sort of a next wave of economic growth in Australia.
That's a bigger conversation, but, a crucial few months ahead before the RBA next meets. Angela Jackson, thank you very much for your time.
Thank you.
That was economist Angela Jackson just talking us through some of the key factors. The RBA will be looking for data on jobs and inflation before it decides to cut rates.
Let's go back to David Taylor now, who's outside the Reserve. David, Nadia mentioned that you've been looking over the statement that is issued every time the Reserve Bank makes an announcement on interest rates. So do you detect any change in the language in that statement?
I do, Roz. And look, this is actually quite fascinating. I know it's a rates on hold decision, but Angela made a few great points and I'll just elaborate on them. There are two crucial issues at the moment. There are potentially too many Australians in jobs, and that's not to say that the unemployment rate needs to rise, but the forecast was for about 4.5%. And it's about 4.1%, 4.2%, something like that. So the initial thought was that the jobs market was too tight, putting too much money in people's pockets to spend. So how the jobs market evolves over the next 6 months is crucial as to when the Reserve Bank can cut interest rates. But the second thing, of course, is productivity. And the Reserve Bank makes mention again of the fact that it's too slow. So they're the two things potentially stopping the Reserve Bank from cutting interest rates, certainly in February, but then again in May. But the second is actually quite important. Now, I've scanned over this a number of times and I don't think I have found it. But in the last 4 or 5 meetings in this statement, the Reserve Bank has said that it's vigilant to the upside, vigilant to upside risks in terms of inflation. That doesn't appear to be there. Now, I could be corrected on that, but I haven't seen it in the statement. And instead, crucially, the Reserve Bank is saying it is, quote, gaining more confidence that inflation is returning back to the target. And what we've been waiting for over the last 6 months is for that phrase, for the Reserve Bank to say that it is confident. The headline inflation is between 2 and 3%, but that trimmed mean is outside. And what the Reserve Bank is saying today is that it's gaining some confidence that that inflation rate is moving back to the comfortable range of between 2 and 3%. And that's largely because of that gap between demand and supply. The demand is at least staying stable, if you like, and supply is lifting. Now, in economics terms, if you've got lower demand and higher supply, price comes down, price being inflation. So the hope is that what the Reserve Bank is doing today is at least laying the groundwork for them to change their language in February to say, look, there might be a rate cut later in the year. It's still unlikely, I think, in February, but at least the Reserve Bank has opened the door to say it's gaining more confidence that inflation is returning to target, and Ros, that obviously leaves the door open to a potential rate cut.